Hi, it's Frank from CappThesis. Today we'll be discussing the most bullish market trait there is right now. We'll also look at market breadth in a very specific way. And at the end, we're going to break down market rotation from an angle that you've never heard about before. So stick around. Okay, let's get into it. And so first, let's talk about how many bad closes there have been. And going back to the beginning of the rally, there have been very few. We're running at between 75 to 80% of the time that the market has closed above its intraday midpoint. That happens on a continuous basis. Obviously, it's a bullish sign, and we've seen that play out now for 5 months. But recently, things have changed a bit. As we can see here, the market has closed, or the S&P in particular, has closed below its intraday midpoint 5 out of the last 7 days, right? And so that's something that we haven't really seen too much, and we definitely haven't seen a cluster like this. And so, of course, the concern is that that starts to happen more often. And if we see that, it means that there's distribution out there, and really that'll be a change of character that we have to pay attention to. But remember, this is only one facet that we've been talking about, but it's been a very important one. Now, looking a little bit more closely at those last 7 days here, we can see that the associated movements, especially on the downside, have been quite small still, right? The biggest one being a 60 basis point decline on March 15th. And 2 of the times we actually still had positive closes. Again, we want to see more closes near the highs or at least above the midpoint. But if they're going to happen like this, we're going to have a cluster of 5 out of 7 that close below the midpoint. Clearly, we want to see small movements, especially small losses along with it, which have been having. And so the question is, what is the most bullish stock market trait right now? And if you think about it, we all know the answer. The answer is boredom, right? What does boredom do for the market? If you hear about a boring tape, of course, what do you think of? Maybe there's some doldrums, maybe holiday trading, but really boring stock market activity is what creates uptrends. Specifically, a boring trading environment means small number of big moves, as we talked about many times, low volatility, low two-way volatility, meaning not a lot of 1% moves on the upside or downside, clean breakouts, which lead to successful bullish patterns, and failed bearish patterns. You put all that together, it produces an uptrend like we've seen now for the last 5 months. And this is that current uptrend. We talked about this chart before. It was tested 2 times in 3 days earlier this month, and it's continuing to hold. We know things will not be this consistent forever. We've been saying that for a long time. But as long as what we've seen in terms of what the market's been giving us, there's a good chance that the trend, whether it's this trend or something different, can continue to advance. And so low two-way volatility, again, we've talked about this in the past. It's an extremely important point. It's simple, also very powerful. And we started tracking this actually in the beginning of 2022 because things really started to change. A lot of big movements on both sides, almost 131% moves on both sides in 2022, and just about an even amount up or down. This is what happens in bear markets. In bull markets, the opposite occurs. And really, from our angle, that changed here in April 2023, when we averaged about 10 per month, dropped down between 3 and 5. Right? And most of those times, we've had more 1% gains than losses. In fact, 9 of the last 12 months have more 1% gains than losses. Needless to say, we've been higher most of that time. The only month that really stood out on the downside was October. As we know, 8 1% moves with 5 being to the downside. But in hindsight, that was an aberration, where since that point, it's been as consistent as we could imagine. But again, let's not forget about what happened from April through the middle of August, or at least through the middle of July of last year. Same type of thing. So the more of this happens, of course, it creates a trend, of course, meaning an uptrend. And so in terms of breadth, right, different ways to look at this as well. We talked about the cumulative advanced decline line, so forth and so on. Another way is to track the number of stocks that are trading above specific moving averages. And so this is looking at the percentage of the S&P 500 trading above 200-day moving average. And so that has continued to come back from under 25% at the October low to hitting a high of 82% just a few days ago. So as we can see, that is the highest level we've been since the beginning of things turning lower in 2022. So it's higher than what we saw in the peak in July of last year, higher than what we saw at the peak in February of last year. So from this angle, an easy way to talk about it is saying that we're really overdone now, right? We've overshot even in the amount of stocks trending above the 200-day from back then, and it's due for a pullback. That could happen. But remember, as the market continues to catch up from the October 2022 low, more and more stocks are going to reclaim their 200-day moving averages. So it's a natural progression. Another thing to think about is a different perspective going all the way back to 2009. And we can see that this 82% is obviously on the higher end of the spectrum here, but not nearly close to the extreme levels. So the most that we saw was in 2021, 90%, 97% were above their 200-day moving averages. That, of course, didn't last. But what also is apparent is look at the amount of time that the S&P had at least 80% or more above 200-day, right? Multiple months, the longest span here being late 2012 to late 2014, right? You're talking about basically 2 years of staying above 80 or thereabouts, getting back to 80. And that really was the middle part of the rally that was from the late 2011 to really the middle of 2015 before that volatility. So it tells us really two things here, that this number could get larger. You can hit 90%. And if it's going to be part of a much longer trend, then it could stay or at least keep on revisiting the 80 level, for months or even longer to come. We don't know the answer, but we can know that in the past, right, these type of environments, really low volatility we've talked about, creates uptrends like this, and uptrends can last longer and they pull more and more areas with them, which causes this number to be as high as it has been and higher in the past. And so let's talk about rotation. As we know, it's the hallmark of any uptrend as well, and more areas have been taking that leadership baton over the last number of months. Started with technology, and then when, of course, we know industrials have been breaking out, and recently energy. That's all very important, but we want to see more than just performance rotation or performance leadership. What we want to see is rotation of breakouts as well, because some of those areas that are broken out have already achieved their upside targets. Some of the biggest moves, and we'll talk about some of them as well. Whereas other areas, we know them, have come back from the October low, but still looking for that elusive breakout. And for that to occur, we need that rotation of breakouts when areas that are now extended need to pause, and we need to see that reflected in areas that haven't broken out yet, finally get through key resistance points. And so here's just a few examples. So the COWZ ETF, it's been a popular one recently. I think one of the reasons is because of its simple name, right? It's easy to say and easy to remember. More importantly, it's been making new highs along the way. It broke out a few weeks ago and has been extending that breakout ever since and getting close to the high now. What this looks at first uses the universe of the Russell 1000, and then looks at the 100 stocks with the best free cash flow over the last 12 months, right? And so it's important to realize that means looking at really large cap value. They also have other ETFs, and one of them is the CAF ETF. Surprise, surprise, small cap cash cows. Now this one used the S&P 600 small cap index as a universe, and the same type of thing, looking for the best 100 stocks within there. And as we can tell, this has yet to break out. And so it had, a great run from October through the end of last year, but it's been consolidating since that point, waiting to break out. We've seen other ones like this as well. We talked about the IWN, Russell 2000 value, same type of thing, right? Still waiting to actually break out and take that be the next one to actually have an upside target achieved. Even in the financials, right? Insurance has been leading for quite some time, KIE ETF. At the beginning stages, right, everything else was just getting started, getting back to potentially getting to resistance points, and KIE had already broken out. And now, since that point, it's already hit its very substantial upside target. Or other areas in financials, like KBE, Bank ETF, has some regional banks in here as well, hasn't broken out yet. It's come back, same type of thing, where it's really just moved sideways, back and filled for a bit, through the last few months, getting ready to potentially break out again. And then even technology. SMH semis, we know all about this, right? One of the biggest patterns, one of the biggest breakouts, and hit this target really, really quickly. Think about how long it took to get back up here, right? We're talking about the low from October 2022. It broke out officially just a few months ago and already hit its target based on, of course, everything that's going on and helpful within its holdings. And so, do you think the SMH needs to pause a bit or at least slow down? This pace probably can't continue, but if the market is going to stay afloat and needs help from other areas that haven't broken out yet, and there are some within the growth space that we could look to, one of them being ARK. Now, we know that there are some smaller names in here, and clearly they've come back as well, right? Big move from the lows, one of the largest, actually. But again, got hit pretty hard at the end of the year and the start of this year. And ARK has been oscillating around its 50-day moving average since January, trying to really stay above it now. And if it can, this is what's potentially at stake here. We're talking about a pattern, actually two bullish patterns underneath this, or right near the low 50s, where if you break out, you're talking about a move that has taken, almost 2 years to take place, to form. And if it can, of course, then we have a measure move back up to here. But really, that would just, release some pressure here, that, of course, that has been on it, and the resistance is preventing it from breaking out. So as we can see, we need all these things to continue to occur for this market, to continue to rally. Of course, we'll be looking at into April how this rotation of breakouts especially goes through. That's it for today. Don't forget to check out these videos and subscribe. I'll talk to you next time.